ne sont pas... Serge, on peut avancer avec la slide.
Federico?
Alors,
je vois que l'on parle français.
Selon nous, les contrats de service transport...
si vous voulez, vous pouvez parler français, mais je préfère anglais.
Meilleurs
pour surtout pour l'italien.
Les paiements et la détermination des pertes.
Federico, mi sente?
Parce que les paiements et la détermination des pertes, finalement, sera réglé dans les codes de marché et les grid codes régionales. Mais quand même, on a introduit des prévisions de base afin que les marchés de l'OMVG et les échanges sur l'OMVG puissent quand même être mis en place.
Okay, Federico, I sent you an email to ask you to switch off your micro, please.
On met la responsabilité à SOGESA de déterminer
I guess
dans chacun point de livraison afin que chaque producteur puisse calculer l'énergie qu'il doit injecter afin de livrer la quantité contractuelle au point de livraison. Et les quantités mesurées au point d'injection et de soutirage seront utilisées pour compenser les écarts restants.
Per favore, Federico? Ecco. Fantastic. So, Olivier, I'm very glad to hear someone from Institut Français du Pétrole, the prestigious institute that for decades has produced very high quality research for the rest of Europe and the world about the oil industry. And since the oil industry is not so fashionable now, it is not so frequent to encounter your material. So I'm very glad, and I'm very interested to hear your speech, your paper, your presentation about the refining sector. And you traditionally, the Institut Français du Pétrole has always paid a lot of attention to financial aspects of the oil industry. J'ai un livre. I have a book, one of the first I studied back 3 decades, almost 4 decades ago, that is that of Massaron. I do not remember the title of it. Should be
The Economics of Hydrocarbons. Yeah,
the Economics of Hydrocarbons. It was. It is now a reference of the economics of the oil industry, and he spent a lot of time in a lot of space on the refining economics. So still now, oil is the main fuel of the world energy balance. Oil is not consumed as a crude oil, as a crude material, but it's always refined. So it is extremely important. In the meantime, Olivier, if you agree, Case Wagon has entered on the platform, and I suggest to follow the list of the program. Good afternoon, Case. It is a pleasure to see you.
Good afternoon too.
Yes, oil is, saying, is always the main primary energy source of the whole world energy balance. So Nigeria is one of the most important exporting countries of the oil industry, especially the first one in Africa. Oil is so important for we consumers, but even more for you exporters. I have officially to thank you, since OPEC in this moment is helping us a lot, Europe, because oil prices are quite stable, even weak, in these last few days.
Yeah.
Compared to the astonishing energy price crisis that is taking place on gas and on electricity. So thanks a lot.
Thank you very much. You're welcome.
Yes, because we are so dependent on oil consumption, it is so important. So I look forward to hear from you, your presentation. You have 20 minutes.
Okay.
And we leave 10 minutes or 5 minutes for questions and answers. Please,
okay.
The floor is yours.
Okay, thank you very much. Please allow me to share my screen. Okay. Just let me know when you can see. Thank you.
I do not see now. Something is charging. Yes, we see it.
Okay, okay, that's great. Thank you very much.
Welcome.
Confirm if it's on a slideshow.
Yes, no, it is not on the slideshow, but we see it perfectly.
Okay, how about
now? It is now.
All right, lovely. Thank you very much. So it's my pleasure to be seated, presenting to this distinguished audience on some of the research work that I've been doing together with my colleagues listed on the cover. I appreciate the time and the opportunity to be able to speak to the issue of estimating upstream unit of production costs for the allocation of crude oil. And just like you had indicated, of course, this supply of crude oil is important for balancing of markets and keeping prices, energy prices steady. So in this particular report, what we seek to do is to introduce the issue that we are looking to deal with, which is in terms of estimating upstream cost of production with a view towards ultimately optimizing the allocation of crude between export and domestic use. But for this presentation, we will just focus a lot on the costs, upstream cost of production part of the equation, so to speak. So very quickly, the optimal allocation of energy resources or oil to different uses is important for us as a country, like you have already indicated, because it serves as a source of export as well as a source of energy. And it's also very key to the conversation we have around energy transition, especially for a country like ours that depends a lot on the resources from exporting, as well as the question as to for how much longer we can keep producing it and what the lower costs of production options are available to us. So it's a very important part of the conversation. So, but in the main body of the work we have done, the research we have done, we've actually developed a mathematical program to enable us optimally allocate crude oil to different utilization options, such as export, domestic, or even for exchange purposes. Now, to be able to do that effectively, we need to establish or have a sense of what it costs to extract the natural resource or to produce it on the upstream side of things. And it is not just for our purposes. We find that generally for energy systems modeling, there needs to be an idea and appreciation of what those extraction costs are. Hence, the focus of this paper, which is to estimate upstream production costs, which is a key parameter for our modeling. Just also give us a sense of the kind of framework we're looking at. This is generally what it is. And for this discussion, we'll be focused on the segment E, that's the oil supply module, where we'll be addressing specifically the cost of the upstream production of things. But you can see generally the flow of energy from production through to its refinement and then ultimately distribution either to export markets or to domestic markets. Historically, this is what Nigeria's production has looked like from when about the time our industry came to be, almost 60 years ago now. We moved from about humble 50,000 barrels a day in 61 and then quickly reached a peak in less than 2 decades at 2.3 million barrels in 1979. It suffered a decline, then with some, up and down upswings, but in 2001, again, production reached its 1979 levels. And from then on, it has vacillated, as you can see. And right now, as we speak, it is actually trending downwards. The summary here is that we've produced a total of like 37 billion barrels. And of this 37 billion, it has gone to different uses. Either it's been exported, and in recent times, a high proportion of that has been exported. And it's also been used to supply domestic fuel needs in country, either through domestic refineries or by some other refining needs. Now, critical to what we are discussing here is the cost of the production that has taken place, because it is critical to the optimal allocation that we have alluded to. And now we'll launch into the way we think about how we're going to be going about estimating that particular cost. Now, several other approaches have been adopted to come to an understanding of what upstream cost of production is. Very common approaches use bottom-up engineering approaches. Some use some other regression techniques to try to get factors that drive costs. But for our purposes, we chose a different path, and this was born out of some form of necessity. Essentially, what we chose to do was to use the tax receipts that the government has received in the last decade or so as a basis to estimating what the historical costs have looked like. And the schematic you have on the screen right now showing is really a schema for how Nigeria's petroleum taxes are computed according to the law, right? So what we have done in here is to, one, translate this schema into a mathematical form to derive a model. Then we have obtained relevant data, which include things like oil prices, production levels, tax receipts, royalty receipts. And then we have sought to work backwards what that unit cost would look like. But in doing so, we have now introduced a simulation modeling into the whole framework to enable us come up with a robust model to explain not just the historical costs, but also make assumptions around forecasting of those costs. And let us remember, all of this is for the purpose of optimizing the allocation of the resource. At the end of the day, this is the cost model we have, essentially saying that the cost is essentially the revenues less royalties, and then an adjustment for the tax receipts. The table there speaks to the kind of variables that we require, as well as where those are sourced. You can see that a lot of this data is sourced from the National Oil Company, the central bank, as well as regulators. Once this is sourced, we then put those numbers into that relationship there to obtain the cost. And this is just a bit of a background as to what the inputs have looked like. So the graphic on your left is speaking to production from 2010 to 2019. You can see how it has generally dropped. And if you look at it just by eyeballing, you see that it tends to track with oil price movement over that same period. And to your right is really the graphic of what tax and royalty receipts have been. Just like production and just like price, we see taxes have declined from a high of something like 20 billion in 2012. As of 2020, tax receipts fell down to $4 billion. And they see the same trend in royalty. Royalty fell from 4.6 in 2010 to something around 3 billion in 2020. But these are the inputs that will go into determining what our costs look like. This graphic here simply speaks to the descriptive statistics of those key variables that we've just described on the previous slide. You see that generally over the period we looked like, we take the average, oil price average around $76. Production in terms of annual has been around 767 million barrels. Royalty receipts, 4 billion, and taxes have averaged 10 billion. But the reason we have these descriptive statistics is to enable us launch into the Monte Carlo simulation that will enable us derive the unit cost forecast model. And we have chosen the functional form, the linear functional form described there. This is just a bit more on the relationship we derived. Of course, using the relationship we talked about, we were able to come up with what the unit costs would be for the same 10-year period that we looked at. And what we found generally was that this unit cost actually averages around 70% of oil price. So historically, what we see is that the unit costs of, as we have shown or derived, is actually around 7% of oil price. In reality, it has actually varied between 63% and 77%. And so based off of the numbers we have obtained historically from 2010 to 19 for production, price, royalty, and taxes, we're able to put together within the framework of the Monte Carlo simulation to derive the relationship that we have above for the unit cost forecasting. The point of this is really to enable us make a forecast of what unit costs will look like as a function of oil price and production. Just reading this off very quickly, we'll see that our regression tells us we have an 83% adjusted R square, as well as a very significant impact from oil prices on unit costs going forward. So this brings me to key conclusions from the work we've done so far. We conclude that cost estimation approach utilizes tax receipts to infer industry costs. And this is because we needed to have a way of assessing what historical costs have been, as well as getting a sense of what future costs have been. And given that we know that taxes are a very important aspect of, or taxes incorporate costs, we thought that it was a very good idea to look at the tax receipts and try to relate it to costs. Also, we historically find that unit costs have ranged from around 63 to 77% of oil prices in the past. And on average, this comes down to around 70%. We also estimated the unit cost as a function of oil price and production, like we just showed on the slide before now. And the reason for doing this is to enable us make a forecast of upstream oil production costs going forward into the future. Again, I will remind my audience, the reason for this forecast is to enable us carry out optimization of the allocation of our crude oil between the various utilization options that are open to us. Now, the other uses for this model, of course, will come down to things such as performance reporting. You can use it for budgeting, tax forecasting, and as well as energy system modeling, which is really the purpose to which we have deployed our effort in this particular instance. I want to thank you very much for your time and attention. I also want to acknowledge my co-authors who contributed immensely and significantly to the output that I have presented this afternoon. Thank you very much. I will be ready to take questions now. Thank you.
Okay, Mr. Case, Bagon, thank you very much.
Thank you. Thank you.
I propose to raise questions immediately. And while we are waiting from the public, if there is anyone who wants to ask something, I have one. I was wondering, when I saw your title, I thought that I should see estimate of costs not related to prices. That is a more simple estimate of costs of production in Nigeria. Comparable, I suppose. I thought cost of production per barrel in Nigeria should be close to $5 per barrel, very low, or $10 per barrel, like those in Saudi Arabia. It is this kind of estimate. I know that it is not so sophisticated for the purposes of your research. But at the meantime, I was wondering if you have considered a simpler estimate of actual costs of production, like those that, for example, your Nigerian state oil company is making when they have to decide investments and they produce business plans with 10 assumption on final prices. So anyway, this is my maybe not too intelligent question on the subject, but I cannot resist, because You see, the oil prices now are close to $70 per barrel. And each time when I'm considering that costs of production in the OPEC countries is close to $10 per barrel or even lower, I'm always a little bit surprised. So if you can say something about this point.
Yes, thank you very much. Thank you very much, David. I appreciate the question. Nigeria is, in terms of cost profile, you would have heard in the public space about the serious efforts within Nigeria to actually bring down costs to those levels that you have mentioned, $5–10 per barrel. Because of course, if costs came down that level, then it means obviously there's much more of the pie to be able to share for government, government take, as well as profitability for the companies. I should also point out that the reason that necessitated this approach we took is due to the difficulty of actually assessing, costs for production. And because we're trying to do a modeling in terms of optimally allocating, wanted to get as close to what those costs look like in terms of cost of extraction. And we realized that one of the ways of doing it, because of the way our fiscal system is structured, one of the ways of doing it we thought was to explore through the means of tax receipts. Because the way our fiscal systems are structured, tax receipts depend heavily on costs, because those costs have to be deducted before the taxes are applied. Now, using that framework was what led us to this idea of doing it in this manner. I realize that it may come as a surprise, because if what you are seeing is that oil price costs take up almost 2/3 of what oil prices are. But again, let us remember that in Nigeria, historically, before the passage of the recent Industry Act, our tax rate has been as high as 85%. And this can drive a lot of what they call tax savings, or rather the savings index. It can impact on what the savings index would be, thereby that will show up what the costs were. So of course, we are hoping that as researchers we will repeat this exercise a few years down the line, when the new Industry Act, which has lower tax rates and is meant to encourage higher levels of investment, would have kicked into play, and we'll see under those circumstances what costs would look like. But these are some of the reasons why you are seeing what we have found out from our research. Thank you. Hello? Can anyone still hear me?
Yes, we do.
Oh, okay.
Okay, sorry, Kenneth. Thank you very much.
Thank you.
And I suggest if you can take off your screen, we move to Olivier Massol of the Institut Français du Pétrole, quite famous institute where important studies have always been done on the oil industry. As I said before, oil is still the first primary energy source in the world energy balance, and also in fact of Europe, and almost in all countries, because of a strong link with energy demand in transport, where oil products must be produced by refineries. And now we will hear what are the reasons for which refineries and oil companies or state oil companies are investing in refineries, and why. So, Olivier, thank you very much, and the floor is yours.
Thank you very much, Davide. I must confess that, well, I think you're creating somehow, your introduction somehow creates very high expectations to the audience, because what I'm going to present today is mainly the outcome of a very preliminary set of researches that we have started. As you mentioned, I mean, refining has always been super high on the agenda of my institution, which is AFP Énergie Nouvelle, which is basically formerly the French Institute of Petroleum. And it's true that the institute has over the years developed many patents aimed at developing the technologies for refining processes, and has accumulated quite a fair amount of knowledge from a technical perspective on what are the drivers of these activities. But still, I mean, everything is changing, as you rightly mentioned in the introduction of this session, and the world is changing fast, both in terms of industry expectations, in the share of oil in the global energy mix, but also in terms of how the value is created in this industry. And so it's interesting to understand how this industry changes over time. As you rightly pointed, in the past at the institute, there used to be a tradition of conducting research that had somehow a monographical nature. I mean, and Jean Masseron's monography of the oil industry was very much in that spirit, which was basically aimed at accumulating a detailed knowledge of the industry and trying to disentangle what are the drivers for observing the different patterns. And in Jean Masseron monography, it was all about discussing what was the drivers of the cost of the exploration production, the cost of shipping, the cost of refining and transforming. But it's fair to say also that the profession has evolved over time, and especially these days that most of economic studies, I'm a professional academic, even if I used to work in industry for some years. I used to work for Gaz de France and ENGIE. I'm back in academia, and in academia, when we look at all the modern studies being conducted in energy economics, it's fair to say also that they are mostly econometrically driven. And it's interesting to see whether there is an opportunity to re-examine what are the traditional drivers for refining using these modern tools, and whether we can provide new insights. And an important reason for looking at this is basically that over the years, we have seen that somehow refining is somehow the overlooked component of the oil value chain. If you look at the literature, and if you look at the number of papers being published, there is a plethora of papers looking at the supply of oil, the extraction of oil, and all the problems related to oil extraction, and the determination of extraction patterns over time, and how they evolve. These patterns evolve depending on different aspects, such as extraction fiscalities and so on. But it's fair to say also that refining is clearly the overlooked component. And it's fair to say that, well, there is very limited literature looking at why a country should implement refining sector, or should basically rely on importing oil products. It's fair to say also that the standard literature that exists in economic theory on trade also overlooks these aspects. And so the goal of this paper is to try to see whether there is an opportunity to bridge two literatures that have so far little discussed together, which is one focusing on the role of energy resources in countries, and using an energy economics perspective, with the standard literature focusing on trade. And so that's typically a very preliminary work. All comments are welcome, and I should very important. I've mentioned that it's a joint work with two colleagues, one from Centrale Supélec, whose name is Quentin Waro, and one from CREST, Institut Politique de Paris, Statistical Institute, whose name is Arthur Thomas. So let's start about it. So as I said, the global refining industry, it's a very important industry. It weighs somehow like value added, which is roughly estimated at around 170 billions of US dollar in a year, in a normal year, I would say. It's still a growing sector when we look at the volumes of oil being processed, and of course we can discuss and have a lengthy discussion about what will be the future of this industry given a possible energy transition, but still it's growing. It has been growing so fast. We have seen also that there has been a lot of reorganization of this industry over the years. I mean, the distribution of energy, of resource processing capacities has changed drastically over the years, with obviously a relative decline of the European sector compared to the Asian and the rapidly growing Asian one. So it's a very interesting aspect. It's an industry where you have an heterogeneity of structure or market structures with in some countries, you have a market structure that is predominantly owned by public companies and publicly owned companies, and in other cases you have mainly a private industry which is under operation. You can have some plants being operated by major companies, which are multinational oil companies, those are the famous, the classical ones, but you can also be in cases where you have solely small players. So it's interesting, and it's a very heterogeneous, and it can be interesting to assess what are the drivers. So what has motivated basically this research? It's basically the fact that when we look at the refining sector, what we observe is basically that we have some countries we are obviously resource rich and who have decided to go and to move along the supply chain so as to process some of their oil they produce, like Saudi Arabia. Recently was opened very large scale refineries that are clearly export-oriented.
Excuse me.
Yeah.
Federico Pontone. Federico, dovete staccare il microfono, per favore.
Yeah, thanks.
Okay, thank you.
Thank you. So as was I saying, so there we have an heterogeneity of countries. If we take resource-rich countries, some are exporting massively and are processing their oil and try to go and move along the value chain so as to export refined products. Others don't care and simply export their crude oil, like Norway. And if you look at oil importing nations, and you have some oil importing nations that have decided to move heavily on refining, and that became a very large refining hubs, regional hubs like Singapore, South Korea, who are clearly processing a lot of oil and exporting a lot of oil products. And we have also other countries that basically merely concentrate on import substitution strategies and prefer to basically import only process a tiny portion of the oil products they consume and import the remaining aspects. And so an interesting aspect is, well, in the end, what determines these different patterns? And do we have something interesting to say in economy to explain these patterns? And so if we look at resource-rich countries, usually the motivation that could be that are proposed in the literature are basically the one which are related to the desire to control a larger portion of the value chain, and it's often advanced as a motivation. But we also know that refining represents a tiny portion of the value chain of the value created by oil compared to oil extraction. We also have always a fascination of local elites towards resource-based industrialization, and it has been documented in many countries, the fact that you have always this fascination for refining being the first step toward an industrialization pattern in many resource-rich countries. And so from a development perspective, industrialization could be a cornerstone for further downstream development by generating knowledge spillovers and innovation spillovers and creating backwards linkages with other activities. Another motivation is also the fact that somehow it could propose some kind of export diversification by looking at a wider set of sources of trade revenue, and so moderate the viability of the trade balance, which is also advanced as an explanation for that. We also have the idea that still refined products, that said, it can be quite complex to organize. It's a complex value chain. The logistics is not so easy to handle, and so one can wonder whether it's always an opportune movement, especially when you are dealing with countries where the availability of skilled laborers can be limited, or the availability of capital as well, if we have some restrictions on that. If we look at now at resource-poor nation, usually a traditional motivation for the installation of a refinery is to argue with, well, refining, it can be seen as a security of supply. For dealing with security of supply, it's a traditional argument that is advanced, and it's true that historically countries who have decided to move on into the development of a local refining industry was basically because they wanted to be independent from the supply of oil products from the majors, and so it was a way for them to gain somehow a control of their own supply of oil products by only being capable to import crude oil, which was supposed to be much easier to find than oil products in those years. I'm talking about the post-war period, basically. So security of supply is always advanced as an argument for developing refining, but one has to wonder whether it's really something that matters. Another argument for developing resource processing rather than processing it in the source country is basically that usually you can have trade theory explanations based on trade theories that could propose that, such as they say that well, if you know the Scherholin-Samuelson model of trade theories that basically stipulate that your endowment in let's say in skilled labor will tell you that you will specialize in resource processing rather than in exporting the resource in itself. So it can be an argument. We can also have opportunities to develop the industry if we are looking for economies of scale, and if we are large countries, could be an opportunity for looking at it. And it's anyway, long story short, what I wanted to say is that, well, we do not have an assessment of the various motivation for looking at for developing refineries, and so far it has never been studied empirically. So our purpose is basically to kickstart that, and again, it's a very preliminary work, so all comments are welcome on that. So if we look at this, so our research question will be the following: well, what are the determinants of refining for the countries? And we'll consider all the countries, not only the resource-rich ones. Our goal will be to somehow analyze what are the purposes pursue when developing a refining sector. Our goal is also to examine whether ownership consideration matters, and whether the fact that we are dealing with a public versus a private ownership structures has or not an impact. Our goal will be to develop that and to study that empirically by looking at data. And we have basically assembled a very original data set combining data from the industries, from the oil and gas journal, such as the capacity inventories published every year by the oil and gas journal, but also all the data available from the international energy agencies or the World Bank. And our goal will be to combine that to propose a few aspects. I will come back on the takeaway after the discussion. So basically, the data. So as I said, oil and gas data. We have annual inventories of world refineries. We have computed also for each refinery a complexity index that simulates how complex the refining operations are at this refinery. It's a synthetic index that measures that. We have gathered some information on ownership structures for each of these refineries, which was quite cumbersome, as you can imagine. And we also have some data at a country level from the International Energy Agency on oil export, oil production, and so on. So here is exactly our empirical strategy. So first, we're going to look at what are the determinants for adopting refining in the countries. So I will explain in a minute how we do that. Then we will move on a very basic question, which is what is the purpose? What are the purposes pursued in developing refining? And lastly, we'll see how whether public or private issues matters. So let's start with the very first, which is, well, investigation number one. Why do countries have a refining sector? And so obviously we will treat that by looking at whether a country has or not a refining sector. And we'll consider all the panel of all the countries over the years. Our goal will be to stipulate that we want to explain what explains why a country is closer to 1 than 0, and it's clearly a logit model that we use. It's an empirical type of empirical model. But among the type of variables we're gonna test, well, we presume that a larger country is in terms of population, in terms of demography, the higher would be its propensity to install a refining sector. We can presume that if the country is landlocked, basically, obviously, it's harder to trade, and so probably it has harder to develop a refining sector which is open to trade, to international trade. Density of population is rather unclear. On the one hand, we can argue that a low density of population means that you have a more demand for road transportation, so it could be a positive aspect. But a density of population which is too low also suggests that we may be in a rural environment where we have less demand for energy. So it's something that is unclear. In terms of economic variables, we can presume that the richer you are, obviously, the more in demand you are for oil products. Human capital, it's unclear. On the one hand, you can claim that, well, refining needs to have a certain degree of human capital to be available to emerge and grow in a given country. But on the other hand, rich countries which have a very large involvement in human capital tend to earn a lot of income, and a substantial portion of the GDP comes from services or IT and so on, which are basically which have a low in energy, which are type of activities with a very low intensity. So one can wonder whether that matters in a given amount, given the sign is positive or negative. Public spending, it's unclear from a macroeconomic perspective. One can argue that it could be a driver for demand, but it's unclear whether it will be the case or not. Trade openness, we can expect that basically the more open to trade you are, the more you are willing to consider to install a refinery, especially for export-oriented schemes, refinery schemes. And we can look at sectoral variables. So are we dealing with an oil production country? Are we? What is the oil consumption per capita? If it's a sizable, we can presume that it will be have an impact. The share of road, the share of consumption structure, we don't know exactly. We presume that it may be have an impact, but we don't know exactly whether it will be positive or negative. And these are hypotheses to be tested. And the share of oil fuel generation in total generation, well, obviously, when oil represents still an important source of electricity generation in a country, we can presume that the motivation to secure these supplies can justify the installation of some kind of refineries in a country. So let's have a look at the results. So we analyze that for resource-rich countries. So I will basically comment a few elements here. First, we observe that larger the population, we still always have a positive impact on the propensity to install a refinery. So clearly, population is an important driver. Density of population is also a very important driver. So it's an important aspect. Unsurprisingly, if you are in a landlocked country such as Bolivia or Luxembourg, you are less willing to install refining capacities, or Andorra. Obviously, now if you look at the basic elements such as GDP per capita, you also have positive relationship between your income and the willingness to implement. But what is also super interesting is to observe that basically, if we move a few lines, we have some motivations that emerge quite rapidly, which is basically, well, if you are a oil-producing country, clearly you have a higher propensity to install refineries. You also have a higher propensity.
I have to ask you to speed up.
Okay, I'm gonna move on to the conclusions. Well, in that case, an important aspect to keep in mind is that oil fuel generation matters for this regression. Okay, looking at now how it affects trades, we have an explained variable, which is basically the balance of oil and products, and we look at whether oil and this balance is affected by the presence of a refining capacity or the complexity of the refineries being installed or the ownership structures. We presume that basically we want to test exactly what is the sign of this relationship between capacity and trade. I will jump on the results, saying that basically we disentangle the cases of the trade, the total trade or the total exports, of crude or of products. A key element to keep in mind is the following: when we look at the case of the total, so the total balance is that, well, for crude oil, the more you produce, the more you improve your balance if you're net exporters, but also the more you produce, the less imports you need for crude or in total. So that's clearly something that happens. And for the refining capacity, we observe that it affects clearly the situation of importing countries, but not so much that of importing ones. If we move on to crude, I just want to say that for the case of crude, a very important aspect is that, well, crude exports affect more importing nation than exporting ones. For refining capacities, we obviously see also that installing a capacity has a negative impact on the total balance. Either if you're in the case of oil and products. For complexity, it's not something that we observe, so we clearly have a difficulty in explaining whether complexity matters from a trade perspective, and so investment in complex refineries is not something that appears to be significant. Okay, I don't want to bother you with the statistics. It's still ongoing work that I'm presenting today. So my goal is basically to provide you with a few takeaways. So we are kickstarting the study of the refining sector using statistics, and it's a very first empirical studies conducted on this industry. So far, it has always been conducted using monographies. We observe that basically refining happens as expected in rich countries or in oil-producing countries, that the consumption structure can have a significant impact, especially when you are dealing with a consumption that is aimed at powering at fueling the electricity sector and at generating electricity.
Okay, I have a question immediately also because we have to move on to the next speaker. The question is exactly attached to the power sector, but not directly through fuel oil consumption in power generation, but through electricity demand for transport. You have in your model the share of oil in transport that we know is over 95%. Are you thinking to do something concerning the penetration of electric cars?
Very interesting question. Yes, that's a very valid question, especially for the evolution of the sector. So far, what we're looking is clearly looking based on the past, and we're not trying to anticipate, to elaborate on future outcomes of the industry based on this past. Our goal is simply to understand how and why refineries basically collapse in some areas, and obviously in Europe, and also flourishes in others. And we would like to somehow provide insights on whether location of these refineries is driven by fundamentals of trade theory rather than evolution of technologies. But that's a very interesting point, and that's something that we will address in future research.
Okay, fantastic. Thank you very much. Also, because I remind you that according to the Fit for 55 package, in 15 years' time, there will be no sale of internal combustion engine cars. For diesel and gasoline will disappear. Anyway, it is, of course, as a target. It is quite interesting to work on this point. Okay, we move. We move with the presentation of the paper from Pontoni, Federico, and his colleagues from Fondazione Enrico Mattei. Fondazione Enrico Mattei Foundation is a research institute based in Milano within the ENI oil company, and is traditionally is one of the main research center working on energy transition. And they are dealing today with an issue that is extremely important in these days, coal phase out or coal importance, since, for example, now in Europe, there is a sharp rise in coal consumption since natural gas is so expensive. So, Pontoni, the floor is yours, if you are among us still now, because I do not see you anymore. Non si capisce bene dunque. Can we move to the last presentation? Professor Pontoni has some problem with connection. So I received a message from Pontoni. We move to the last presentation in the program, that of Krzysztof Drakal from Poland. Thank you, Krzysztof, for being so flexible to switch immediately on. And your presentation is on oil price forecasts. And through mathematical model, artificial intelligence, I have to make a complaint on mathematical model and financial instruments in the oil industry, because I do not understand all this instability of oil prices in the past, not now, but more in the gas and power market recently. So I am a little bit concerned that all these tools enabling financial institution to make a lot of financial decisions, investment decisions, are affecting the energy markets as far as stability or instability, variability is concerned. Anyway, I do not know, Christopher, if you are dealing with this subject, but in any case, I would like to see your oil price forecast for the next decade so that I can decide if I should buy or sell futures. Thank you.
Thank you very much for the introduction. I will try also to answer some of your questions during my presentation. I hope it is already seen, yes?
Yes, we see.
Yes, and you can hear me, yes? Okay. So, as you already said, my method is can be applied to not only to oil prices, although I was working mostly with oil prices with my models, but half to half I work with just oil price, and half to half I'm interested in applying some econometric methods or some methods from engineering sciences or signal analysis to time series. So the idea is, as you said, that we have some time series. In my case, it's actually spot oil price, which can be affected by many variables, and conventional econometric models they usually require us to narrow the explanatory variables to quite small amount, like just a few, because just in the theory of, for instance, ordinary least squares regression, we must have matrices of enough dimension. These matrices must be invertible and so on. Or roughly speaking, there is a problem that if you have too little observation, too short time series, but too many variables, and you include all the variables in the models, then such a model gets too much errors, too much, the estimated coefficients become too wide to make a reasonable forecast. In case of Bayesian econometrics, we start to better model such cases, because the rough idea is that we don't get some fixed in-sample period and then we have fixed coefficients, but we rather try to make like this, that we have some data up to now, we estimate the model, we have some assumptions about making forecast, we get some coefficients, but as tomorrow we will have new data, we can use this data to update our assumptions, our beliefs about the estimated coefficients, and make our estimation more precise, because we already get new data. So we are continuously updating our forecasts with new data. The second point of my models is that if we have many variables, for instance, if I have n variables, I can construct up to n different linear regression models. So if n becomes even 10, 15, 20 variables, then this number grows exponentially. And if we are not so sure and don't want to make a human bias guess which variables to choose, the very greedy approach would be to consider all possible models and then start to do something with this. Or model selection, select the models, but by some algorithm, or the approach that the models that I was considering are more towards this solution is to give each of the models some weight and to construct a weighted average from forecasts of all possible models. And behind these complicated formulas, which are explained in the original papers, the rough idea is that also model averaging done in these models, the models are called dynamic model averaging. This averaging is done in a bit witty way. It's not equal weights given to each of these models, but the weights are somehow also recursively computed in such a way that we have some kind of forgetting, like if the model was in last month, for instance, forecasting well, then we want to give him higher weight. But if the model was forecasting poorly last month, we want to give him smaller weight if we are making the forecast for the nearest future. But what about situation that the model was performing very well 3 months ago, for instance? Then we want to give him also somehow of boost in this weighted average forecast, but not so big as if it would be last month. So the information from the past we want to include in less importance in this weight. So more or less the weights in the model averaging scheme in dynamic model averaging is also time varying. So not only model coefficients, individual component linear regression models, but also weights in model averaging scheme are time varying. But as I just said, in the original dynamic model averaging scheme, if we consider even number of variables just 15, 20, then unfortunately this model, the original model, which is projecting good if we have 10 or 15 variables, if the number goes higher, it starts to be computationally infeasible because we get a ridiculously high number of individual regression models, and it's even not computations even, but just the logic behind considering too many models stops to be just a reasonable thought. And the idea to improve the dynamic model averaging comes from applying genetic algorithm. And in very, very short, the linear regression model we can write like vectors. Like if I said I have n potential variables, by the vector of length n or n plus 1, if I want to consider also constants, I just consider the correspondence between function and vector, like if the variable is included in the model, I give this variable 1. If the variable is not present in the model, I put 0. And let's say that I have some initial population of models that somehow I have chosen. It can be random, selection of models. I don't want to consider all possible up to n. I want to somehow limit this number below to make computations feasible, lower number. So for instance, I can randomly select some models, or I can, for instance, consider only models with one variable. So just model constants plus x1, constants plus x2, or something like this. Let's say I have some initial population of models that I want to perform original DMA scheme over it. And if I perform this scheme up to some time t, then for the next time, for the next forecast, I want to change my populations of models. And I make it in the following way, that first of all, I compute weights for these models, and and I just select some number of 10 or 100 or 1000, depending on the general number of models that I'm considering, some reasonable number of the best models, the models that obtain the highest weights. So in this way, I can throw out the least promising models. And the idea from genetic algorithm how to expand now the set of these models is to use mutation and crossover. Mutation is just to randomly switch, like in these vectors, replace 1 by 0 in some random place, or 0 by 1. So it corresponds to the fact that I add some variable or I delete some variable from the individual component model. And I can perform mutation over some randomly selected models from the population. The next step is crossover. So it's easily seen on these vectors here, that I just in random place split the vector, and I replace the parts of two also randomly paired functions. These vectors are representations of the function. So it is something like I would take scissors and cut the formula in one part, another formula also in some part, and glue them together. And like chromosomes, I would obtain a new function. Two new functions. And with such a way, after these procedures, I obtained a modified set of models. And I perform original DMAs over all of these models again, but for a bit more data. And recursively, I repeat and repeat such a procedure for a whole data set. The idea here is that if K is a really big number, this genetic algorithm, this cutoff, like I take only the best models, but then I somehow modify them, computationally, this becomes much more efficient than original DMA scheme. Like if n is very big, it's more fast to compute this way that I presented, instead of considering really enormous numbers of model. And the question is, if because my models now are are in a very this is just beginning of the research. It is now just very simple way of modification. But the idea is, if these models, first of all, predict better than some benchmark models, for instance, naive no change forecast, or if these models resemble DMA. So if this genetic modification really keeps the important features of DMA, original scheme, but makes computational gain somehow. And I took spot oil price. I took some small data set to make the tests, because I want to...
Christoph,
yes?
sorry to interrupt you. I have to speed you towards the conclusions. Thank you.
Okay, so I took some small set of data. I took many simulations, and the outcomes were like, first of all, DMA and these genetic modified simulations are making more or less the same forecasts. So it's good approximation to use this modification. Secondly, both algorithms are well forecasting the real-time oil price. This was, of course, checked by root mean squared errors, absolute errors. I used some tests, also not presented here, to check. And conclusions are that improving with genetic algorithm is good promising to obtain, for instance, 1 month ahead oil forecasts efficiently and, for instance, better than no change benchmark forecast. I'm already also continuing this research in more advanced symbolic regression and to connect symbolic regression and Bayesian approach, which has not been generally made yet in econometrics. So thank you very much for your attention.
Okay, Christoph, thank you. Very sophisticated model, this one. I cannot resist to ask you a stupid question. Where is going the price to be next year?
Unfortunately, I don't make these forecasts yet. This is I don't have updated data. I can only tell that data from last, for instance, 10 years. If you would take last 30 years and start to forecast 10 years ago, you would obtain something like 5 to 10% better forecast in case of squared errors than no change forecast.
Okay, thank you very much, Christoph, and I look forward to see your next steps in order, again, to understand where is going to be the price for the future. Now, the next presentation, the final one, is that of Professor Federico Pontoni. As I said before, his group of research is working for Fondazione Enrico Mattei, FEM, and Enrico Mattei Foundation and Research Center, focusing over the last several years on energy transition within an important energy company in Europe, that is ENI. Federico, if Pontoni, Professor, if the system is working, okay, the floor is yours. The title and the subject presented is dealing with the electricity market that is going right now through a perfect storm. Prices yesterday touched a new record at 300 and almost 50 euro per megawatt hour. And we have a lot of troubles now with the electricity markets. I suppose that your research started before. We have to look forward to find solution, and probably your research might be helpful to find them. Thank you, Federico.
Thank you. I hope that you can see my screen and you can see my presentation. I'm sorry for repeatedly creating background noises as well as connecting and disconnecting. Unfortunately, the internet connection here is not perfect, but I hope it will last until the end of the presentation.
It's working perfectly now.
Okay, so as you can, to answer your question, our research started before, of course, this explosion in power prices, but we think that it is very relevant, particularly that we wanted to understand what will happen with the phase out of coal in in the Italian market, and we have seen right now that with these very high gas prices, notwithstanding the very high ETS prices, the share of coal production has been increasing in the past months, and we, by the way, we were able to capture it in our modeling exercise. So the presentation. So this is the structure of the presentation, the rationale of our project and the research question, and then we will briefly go through the Italian power system, and then we will see our the results of our model. First, we calibrated the model on the year 2021, and then we have a simulation for 2025. So as you probably know, Italy has decided to phase out all its coal-fired generation by 2025. It is the first nation, important industrial and advanced market, power market that decides to phase out completely coal-fired generation, and it will be phased out in 2025, apart from the two power plants that are operating in Sardinia, which will be phased out in 2028. And it was postponed because only in 2028 a second link with the continent will basically allow Sardinia to respect all the security parameters that we have. Of course, Italy has never relied too much on coal-fired generation. Still, it was an important part of its generation, particularly providing cheap, let's say, base load power. And it was particularly important in the southern part of Italy. As you may know, the Italian market is divided into zones. So as you can see, zone north, central south, south, and Calabria, and then the two islands. So particularly in the south, it was important not just for baseload power, but also for providing ancillary services and compensate with the intermittency of renewables. So phasing out coal will have important consequences, not just on the day-ahead market, but also on the ancillary services market. And that is why relying on Plexus, which is a software that allows a simulation of the hourly market equilibria in the power sector, we wanted to simulate the impact on the Italian power system of the phase out of coal. And more in particular, we wanted to concentrate not just on the day-ahead market, but also on the market for ancillary services, and in particular the market for the MSD, which is the ancillary services market ex ante. And basically what we have developed is a model that allows to co-optimize the day ahead and the ancillary services markets. And we will see why it is important to run the two markets and the simulation jointly, because without taking into account one of the two markets, there is the risk to really not get the importance of dispatchable generation, and therefore you would not be able to estimate correctly the prices both on the day-ahead market and on the ancillary services market, because of course co-optimizing means that I can either provide a certain capacity and a certain quantity of power on the day-ahead market, or I can retain it and then provide it on the ancillary services market. And both in terms of cost minimization, so perfect competition, but also particularly in terms of strategic bidding, it is very important to keep in mind that operators can act strategically on both markets. So with our paper, we want to understand the impact of coal prices, of the phase out of coal on electricity prices, on the generation mix, on the reserves, and whether or not this will impact the strategic behavior of operators. And we also want to understand whether the phase out, let's say, would have happened anyway, because it would have been naturally driven by market forces. Given the limited time that I have, I will skip some parts of the presentation, just to remember that Italy has evolved in terms of market zones, and those are basically, those depend on the fact that there is a limited interconnection capacity among the different zones, and for the market, is split into zones. So whenever there is no congestion, we have a uniform price, but whenever there is congestion, we have a market splitting algorithm whereby we have different prices in different zones. As you can see, historically, we have had many hours of the year where the market is split, particularly if you see Sicily with respect to the continent or the southern zone, you see that it can go as high as 90% of the time that is aligned in some months, but it can go as low as 20% of the time where it is aligned, meaning that 80% of the time it is not aligned. So, and of course, here you also understand the importance of renewables in the sense that it is often more aligned in winter time when there is less production of renewables, and it is less aligned in summertime when it is, of course, for instance, you have higher levels of solar production. And again, north to south, you see that the alignment is in the range of 60 to 70%, meaning that a considerable amount of hours, the prices are not aligned, so we have a market splitting. Italy, of course, is not in isolation, but is interconnected with France, Switzerland, Austria, Corsica, and Slovenia, and it will soon be interconnected with Montenegro, and Greece and Malta. So it's already connected with Greece and Malta. It will soon be completely and fully interconnected with Montenegro. And that, of course, has an impact as well on the Italian prices, given the different generation mixes with Northern European countries. Italy is basically an importer of power. Just to be aware of the fact that, as I said, that we want to optimize. So we want to understand the dynamics on the day-ahead market. So it's the, as you can see, the MGP, the day-ahead market, and the dispatching services market, or the ancillary services market, which is the MST. This is important, as I said, because it is the possibility for operators to optimize and to decide whether it is more strategic to bid and offer power on the day-ahead market rather than offering power on the MSD, which is the dispatching services market. As you can see, the market is very liquid, so it is very complex to simulate it, because as you can see, we have almost 500 terawatt hours that are offered every year on the day-ahead market only. And basically 40% of the time offers are not accepted, meaning that it is a very liquid and a very active market, but it is also a very complex market to simulate because you have hundreds of operators that are offering for every hour of the year their capacity. And renewables represent an important part of the bids that are accepted, and they also have dispatching priorities. So this is also important, particularly when we will discuss the results that we find. Again, this is another measure of, on the one hand, competition, because as we said, that we want to optimize and we want to understand the strategic behavior. The strategic behavior of operators happens if, of course, by acting strategically, they can distort market outcomes. And the measure of distortion is the difference between the resulting market price, which is the PUN, and the clean spark spread, which is basically the cost of generating electricity with gas, including the ETS. So as you can see, the difference, which are the bars that you find below, is considerable in the sense that on average, the clean spark spread is in between 10 to 15 euro per megawatt hour, and in 2020 it went as high as almost 20 euro per megawatt hour. So it means that they can, when the price is 52 and the clean spark spread is almost 20, it means that the generation cost is the pure marginal generation cost is 30 euro per megawatt hour, 30 something euro per megawatt hour, meaning that they are in certain occasions they are able to set a price which is considerably higher than their marginal cost. So that gives us a measure of market, let's say market power, or in any case, the possibility to act strategically. And basically, having explained the rationale of our research and having motivated the rationale of our research in terms of the possibility to detect market power, the fact that gas players, they can operate strategically, and the fact that we are phasing out coal, which can impact both the day ahead and the dispatching, so the ancillary service market. Now we introduce briefly Plexus, which is the model that we have been using. So Plexus is a market simulator that basically really simulates the market by having all the power plants located in all the zones that can be grouped, of course, into companies, and basically what we have is the replication of the system marginal pricing mechanism and the power exchange that we have in Italy, which of course takes also into account the technical constraints of the network. And by running the simulations with, of course, different scenarios and different hypotheses, we can get all the results in terms of hourly prices, generation dispatch, and dispatch costs, and revenues and profit and loss for all the companies. The structure is it can take both the medium and long term to the very short term and real times, in the sense that we simulated with a granularity of 1 hour, but if we could have gone up to a level of granularity of 15 minutes to understand also the implications of all the intermittency of the renewables. And that is particularly important then when it comes also to understanding the need for reserves to manage the variability of renewables. On the right-hand side, you see an exemplification, a schematic representation of a power system, where we have power generation, the transmission, the demand, the ancillary services, and the possibility to store the renewable generation. And then, of course, when it comes to hydropower units, we also have the hydrology, and so we can simulate and optimize hydropower units according to, with the constraints of the availability of water and the capacity of the reservoirs.
Professor, you have still 3 minutes.
Okay, yes.
I have also, I want to make a couple of questions. No, not
absolutely, absolutely. So what we do, basically, we represent, as I said, the markets, and we simulate. And in order to see whether we are doing a good job or not, the first thing that we do is that we basically rerun the year 2021 to see, so it's a standard backcasting, to see whether we are able to get it right. So these are the main assumptions. So we have the essential list of power plants as defined by Terna, the monthly prices of gas, and an average price of ETS, which is this, the current average price. So what you see is that the real outcome is on the first column to the left. So it's the results from GME and Terna. And so we have an average price of 99 euro 0.27 per megawatt hour, the quantity and the emissions. And what you see is that you see 4 models. So in 2 models, what you see that we run a simple day-ahead market without co-optimization with the reserves. And we get, the first one is no reserves, perfect competition. So it's like a cost minimization. And the second one is with a strategic bidding. What you see is that there is, the prices are €5 lower than the realized prices, while on the other hand, if we run the models with the co-optimization, so including the fact that operators can have to also provide services, ancillary services, we see that the prices are higher. And in particular, where we simulate a strategic competition based on pricing competition, okay, so we see that we basically get very close to the realized price. So we have a difference of less than 1%, namely 0.5%. And in terms of quantity, we are basically slightly below. And in terms of emission, we are slightly higher. But you can see that the model performs quite well, and basically in considering hourly, so the correlation of our prices is 0.93 and 90, so always above 0.9, and it can go as high to as 0.94, and that in less than 25% of the time we have a spread of the price which is higher than 20%. So here you see everything and the goodness of our model and its fit, and you see also that we are able to catch the increase in coal generation as gas prices went up, so showing that with low gas prices there is almost no coal generation, but with very high gas prices, irrespective of the price of ETS, there is a huge increase in coal-fired generation. This is what our model is predicting, and what is also happened. So these are standard measures of correlations of our estimates with respect to the price. I just go very quickly, okay, to show you what is going to happen in 2025, and just to understand this table here.
We have
okay.
Run out of time.
Yes, I'm sorry. So basically, what we are showing here is that. So of course, depending on and this is just 1 minute. Depending on the scenario on prices, basically we have different outcomes. But what is important is that the phase out doesn't really impact the generation mix, and we can see it here, because in all the scenarios, the prices of gas are such that coal-fired generation is not really needed. So the phase out would have happened anyway, thanks to market outcome. But the coal, we can see it here, is very important in keeping price lower, because without the potential competition of coal, the strategic bidding of gas producers will increase, and therefore prices will increase. And as a final result of the model, we see that without coal, the prices of the ancillary services, particularly during sunset hours, will skyrocket because of the fact that the coal competition will not be there, and therefore gas-fired generation and gas-fired producer will be able to increase considerably and bid strategically on the MSD market. So in conclusion, we just have to say that co-optimization leads to better fitting. So therefore, there is always the need to do the co-optimization of the head and ancillary services market. And that, on the one hand, coal phase out would have happened anyway in terms of generation, because irrespective of the scenarios, because of the fact that ETS prices will increase considerably, coal would have been phased out by the market anyway. But this will have impact in terms of competition, as we expect more strategic bidding, particularly in the ancillary services market. Thank you.
Okay, sorry, Federico Pontoni, Professor, to rush you to finish. I have several questions. Unfortunately, we have no time. I want to emphasize the big effort that you are making within Fondazione. I'm very glad. I take the opportunity to tell you that I will come, I hope to come to visit the Fondazione. I will ask to your chief, Alessandro Lanza, if it is possible to go through this research you are carrying out. Also, my question will be about the future, about renewable energy sources in the new with the new electricity market design of the future that we do not know, especially after the recent turmoil in power prices. Thank you very much to everybody. We have to close. Thank you very much. And
Thank you so much, everybody, for your attention.
Thank you. Bye.
Have a good time.
You too. Bye. Thank you.
Thank you.
Thank you.